The economy's fine. Totally fine. Prices are up, savings are down, credit card debt just hit a record, and somehow cooking at home is now considered a recession indicator. While everyone's busy arguing about grocery receipts on Reddit, the US economy quietly swapped out its entire engine. No crash, no explosion, just a silent system reset while no one was paying attention. Here's what's actually happening. The national debt just crossed $37 trillion. Which, by the way, is bigger than the entire economy of the European Union. Not bad, just historically ridiculous. Meanwhile, BRICS countries, basically the group chat of nations tired of the dollar acting like the main character, are ghosting US treasuries, trading in local currencies, and pretending everything's fine. And then there's AI. The US data centers running all your cloud storage, TikTok filters, and chatbots are about to double their power use by 2028. We're literally rebuilding the electrical grid so ChatGPT can keep writing haikus about avocados. So no, this isn't a collapse. It's more like a controlled burn, an intentional cleanup that looks messy but keeps the system alive. Most people are watching for a crash. But the real story is a structural pivot happening underneath, across three systems: debt, currency, and energy. And depending on where you're standing, this reset either makes you or breaks you. Let's start with the number everyone pretends to understand, but definitely doesn't. $37 trillion in national debt. That's about 123% of the entire US GDP, which basically means we owe more than we make in a year. Impressive if you think about it. We've turned debt into an Olympic sport. But here's the part that actually matters. It's not the debt that breaks you, it's the interest. Right now, the US is spending over $1 trillion a year just paying interest. More than we spend on defense, more than Medicaid. It's the third biggest expense in the entire federal budget, and it's only climbing. When rates were near zero, this wasn't a big deal. You could borrow forever and barely feel it, but that era's over. The tab came due, and this time, it's charging compound interest. Once the Fed hiked rates to fight inflation, all that cheap debt suddenly got expensive. And here's the problem. When you're this leveraged, you lose options. You can't spend your way out of a downturn. You can't cut rates without waking inflation back up. Even BlackRock, the world's largest asset manager, is sounding the alarm, calling rising US debt the biggest risk to the dollar's credibility and market stability. So yeah, the debt isn't just a number anymore. It's a choke chain. Every policy decision from now on has to account for it. Which brings us to the next problem. What happens when the rest of the world decides it's done footing the bill? If you've been hearing all this buzz about BRICS currencies or countries trading oil in yuan, there's a reason. And no, it's not just a TikTok conspiracy. The dollar's still king. It's used in about half of all global trade and makes up over 50% of central bank reserves. But for the first time in decades, that crown's starting to wobble a little. China, Russia, India, Brazil, and a growing list of countries are testing alternatives. Not because they hate the dollar, though a few definitely do, but because relying on it gives the US a ridiculous amount of leverage. And if you're not the US, that's a pretty awkward power dynamic. Kind of like the internet. You're technically free, but someone's always watching. That's why I use NordVPN. It hides your data, lets you browse from anywhere, and it's 74% off right now. Links below. Anyway, here's what's actually happening. Central banks are quietly trimming their US Treasury holdings. Not dumping them overnight, that'd be financial suicide, but slowly rotating into gold, euros, yen, and even each other's currencies. China's leading the charge, cutting more than $300 billion in treasury holdings and pushing yuan-based trade deals across Asia, the Middle East, and Africa. Russia, after getting hit with sanctions, basically said, fine, we'll trade in rubles and yuan, and started bypassing the dollar completely. And the big one, Saudi Arabia, America's longtime dollar loyalist, just signed oil deals denominated in yuan. Now, does this mean the dollar's collapsing tomorrow? Nah. Building a single alternative currency is like getting your extended family to agree on one restaurant. Technically possible, but emotionally traumatic. But here's the kicker. They don't need to replace the dollar. They just need to use it less. And even tiny shifts matter when you're talking about trillions of dollars in bonds quietly moving around. Every percentage point drop in dollar reserves is 1% less demand for US treasuries. Less demand means higher yields. Higher yields mean more expensive interest payments, which makes that $1 trillion tab we talked about earlier even uglier. So no, de-dollarization isn't a meme or a doomsday theory. It's slow, structural, and very real. One more lever the US is quietly losing control of. And for the Fed, that just made an already impossible job even harder. Now the Fed's standing there like a plumber with a wrench, trying to fix a global leak using tools made for a kitchen sink. They've got three impossible goals: keep inflation low, support growth, and manage record debt. You can only pick two, And lately, they're dropping all three. If they raise rates too high, they crush the economy. Cut them too soon, and inflation lights back up. After 2 years of aggressive hikes, the Fed finally started cutting rates again. Not because everything's fine, but because they literally can't afford not to. The U.S. government needs cheaper borrowing, companies need breathing room, and households? They're suffocating under record credit card debt. Something had to give. But here's the twist. Those rate cuts that used to jumpstart the economy, they're barely working anymore. The U.S. economy isn't built like it was 10 years ago. The engines have changed, so the same old tools don't fix the same new problems. They just buy time. And inflation? It didn't vanish. It just went into witness protection, hiding inside services, housing, insurance, and utilities. The Fed can't cut rates fast enough without bringing that inflation right back from the dead. Meanwhile, the government keeps borrowing to stay afloat, which just stokes the same inflation the Fed's trying to kill. Debt drives rates. Rates drive inflation risk. Inflation risk drives more debt. It's an economic feedback loop, a treadmill with no off switch, and the Fed's stuck jogging in place. At this point, they're not just managing inflation anymore. They're managing the world's faith in the dollar. And while the Fed fights spreadsheets, the real economy is literally being rewired. AI and data centers now use 4% of U.S. electricity, and by 2028, that's expected to double. So yeah, your AC and your chatbot are now fighting over the same electricity. The power grid? It's from the 1970s. It wasn't built for GPU farms. Now utilities, investors, and private equity are throwing billions at rebuilding it. Substations, transformers, power plants. It's the biggest infrastructure upgrade since the interstate highways, and all this to keep the lights on for servers that mostly generate memes and deep fakes. Good news, this build-out's creating a boom. Chip makers, power firms, and construction companies are printing money. Bad news, consumers pay for it. Electricity prices have nearly doubled in parts of the U.S., and they'll climb higher as AI eats power like an unsupervised toddler at a buffet. So who wins? Power companies, chip makers, and grid builders, the ones supplying the backbone of the electric economy. Who loses? Real estate, small businesses, and anyone addicted to cheap money. The free credit era's over. Consumers lose too. Higher cards, higher mortgages, higher bills. The economy still runs. It just feels worse. We're shifting from a consumer-driven model to a capital-driven one. From people spending borrowed money to corporations spending borrowed power. So here's the bottom line. The economy isn't crashing, it's rebooting. Debt's ballooned, the dollar's losing its grip, and AI's forcing a total rebuild of the grid. This isn't the end, it's a reset. The old engines, cheap credit, easy money, endless consumption, are burning out. The next decade won't be about who sells the most ads. It'll be about who builds the power plants, the chips, and the systems that keep the digital economy alive. The economy didn't collapse, it evolved. And like every evolution, not everyone makes it through. But hey, maybe it's time you figured out how to control your money. That's why I made the simple finance budgeting template. Just plug in your income and expenses, and it shows you exactly where your money's going. No confusing apps, no subscriptions, just one clean sheet to finally get your finances together. And here's the best part. It's free. Or if you want to support us, you can pay whatever you want. Start building your first real budget today. Links below.